Now let's go through it because you're probably saying, well, I don't know what the big deal is. If interest rates are lower, it's going to stimulate the economy. More people are going to buy houses. More people can have money for loans in their businesses and things like that. And while that is true, there is a dance. So the Fed always has two goals, and they're contradicting goals. The Fed's goal, right? So they have the Fed goal. So goal number one, low unemployment. And goal number two, low inflation. And the main thing that they do is they adjust the interest rate to achieve those goals. So let's go through how that would look. So these are our economic seasons, right? So this is our economic cycles. We have increases that we would call expansion. And we have decreases that we would call a recession. And so if you remember back when we had really high inflation, what was going on? There was a handful of events going on. So when we had high inflation, number one, everybody had stimulus checks. So we had a lot of money in the market. Okay, excessive money printing, check. We had a whole lot of costs going up because we had the supply chain issues. You remember during COVID, everything was kind of bogged down. We couldn't get the supplies in. There's a lot of ports that were closing and different lockdowns and different measures that were put in place. It was really hard to get the items. We had the truck drivers and we're doing all this stuff. We had emergency workers. You remember, it was kind of a little weird time. Well, we also had the wage cost spiral. Because we had such low unemployment, we had to be super competitive to get someone to leave their job, right? Just right now, just think amongst yourself. If you have a job, what would be the minimum salary you would accept to get a new job? And let's say you like your job. And then if I said you have no job, what would be the minimum salary you would accept? And I think we both agree that the minimum salary I would accept is going to be lower if I don't have a job. Well, if everyone has a job, I may have to offer you something like 20% increase to what you're currently making. So we had the third form of inflation in that particular point in time. Now, the interesting thing that we had was there was also demand pull inflation. You may or may not remember, but do you remember when people were buying houses and people were just paying $100,000 over asking price? Do you remember that? People were just like, you know what? I have the money and I want the house. I got the raise and I want the house. And they didn't care how many people bid on that house. And so they were going way over asking price because people were like, I'm going to get that house. Interest rates are low. Money is high. Everybody's getting raises. We were living La Vida Loca. Okay, that is called, right, economic growth and expansion. The issue with leaving interest rates low when all of this is happening is you already see it. It creates super high inflation, which is what we had. Do you remember that 40-year high of inflation? So what did the Fed do? I'm glad you asked. The Fed said, okay, I know that our goal is low unemployment, but right now everybody has a job and it's just crazy out there. People are just spending money like there's no tomorrow. So we have to cool this market down. How do you cool the market down? How do you lower inflation? I'm running out of space on that side, so I'll place it over here. You increase the interest rates. Because if you don't increase the interest rates, we would just keep going up. Everybody would keep bidding crazy amounts of money on these houses. Everyone would keep getting new jobs, the 24% increases from the last jobs, and we would have the shelves still being empty. It would still go, and that is called hyperinflation, where it just keeps going up, 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 and up. So the Fed will increase the interest rate. So they said, okay, if you had a 3% mortgage, we're going to raise it to where the mortgage is 7%. And there's a couple things that happens here. One is all of a sudden your new house isn't as sexy. And now it causes you to have a much higher monthly payment for a much smaller house. That's a real decision that people have to make. And as you notice, it cooled down the real estate market almost overnight just by doubling the interest rate. People are like, I don't know if I want to move anymore. And so now the inventory starts kind of cooling down. Everybody's like, I'm not moving. I'm not interested. Obviously, we're kind of exaggerating in the sense that nobody moved. Obviously, still people had to move, but there's much fewer houses on the market. That then lowered the demand. So we started getting rid of the demand pool. We started lowering the demand. And then that started lowering some of the prices of the homes. We then, because you have higher interest rates, now money is more expensive for not just you buying your home, but for businesses looking to grow and expand. So businesses started cutting their R&D, which is research and development. They stopped acquiring other businesses because the money wasn't as profitable for them. And when you start doing that, what do you end up doing? You start laying people off, which is what happened. We saw tens of thousands of people starting to get laid off from their position. When you get laid off, we just already talked about it. What do you end up doing? You accept a new job at a lower rate because you'd rather have something than nothing. And so now we start seeing there's this decrease in demand. There's a decrease in the amount of money people are starting to be offered. You start seeing the market to cool down. And so that's what they end up doing. That is how you round it off. That's called the peak. And then as we start slowly decreasing, which is what we've been doing as the interest rate were higher, the Fed last year started lowering the interest rates just a little bit, nothing too crazy. They don't want to accidentally lower it too much and throw it back into the hyperinflation route, but they started lowering it a little bit. So you notice your interest rates went down to 6% on the home. And then you're probably seeing some at 5%, and you may have even seen some a little bit in the mid 4%. And then the Fed stopped right there. So the past Fed meetings, they said, we're just holding right here. We don't think we're quite in a recession yet, and we don't think we're quite out of the woods yet. So when the president says, I want the Fed to lower interest rates because it's going to stimulate the economy, while that is true, the concern is it's going to turn us back, and then we're going to go up back into the hyperinflation, where the average price of a home right now went from $200,000 to like $450,000. That's a big shift, especially if you're a Gen Z and you're coming out of the market and you're like, I don't know how I'm going to get a home because my wages didn't go up that much. And so that's why the Fed has been holding. And so if someone does get elected that's just going to do what the president says, economically speaking, the concern is that if that's going to happen where you go back to hyperinflation, then our money is going to be worth even less, not worth less, but worth even less. And so that is the second concern, because there's going to be a new chairman of the Fed next year. We don't know how independent the Fed is going to be, but high level, it's supposed to be very independent because they can't just leave the rates low because that's what's going to happen. Just think back to what we just went through. That is how the economy works. We have the same 4 cycles, just like the regular seasons. We have spring, followed by summer, followed by fall, followed by winter. Those are always the same 4 seasons. In economics, you have expansion, or we would say growth. Then you have the peak. And then you have the decline. And then you have the trough. That's the bottom. So that is always the same 4 cycles. And at some point, we'll hit the very bottom of the recession and the Feds will lower the interest rates to stimulate growth again. And then you go back into growth. And then at some point, they're going to lower it and it goes back to peak. Those are the 4 seasons. That's how it works. We don't get to decide, I want to have 2 summers this year. That's not how economics works. As a result, a lot of people are saying, if this is true, if what the president is going to do is elect someone that's going to lower the rates before we're 100% sure they need to be lowered just to stimulate the economy in the short term, it's 100% going to create a bubble. You can think back to any time the government starts doing things for these weird reasons, it always creates a bubble because the economy is going to adjust. Oh, well, if you're going to give us free money, I'm going to take the free money and I'm going to invest it and I'm going to grow and then I'm going to pay people because the money is free. Who cares? I'm going to make a great return on my investment. And then we're going to find ourselves in that weird environment where we talk about excessive money printing and we're going to be in hyperinflation. At a minimum, it will be inflation.